$1.50 tomorrow, and then it's worth $2.25 the next day because it's 50% on that 150, which is like 75 cents. So it keeps on compounding on the previous number. And if you went for like 30 days, that $1 would be a huge amount of money because it just keeps on compounding. It's an exponential function. And so here, this 64% IRR means that they're getting a 64% return on their investment every year, which is, fantastic. And the thing is VCs, I know, are using a rate of about 40% to discount what they're estimating your company is worth because they think it's very speculative, they're expecting it to maybe fail. I think probably 80% of the companies VCs invest in are failing, so maybe even more, probably more. And so in order to compensate for the loss that they have, they need to invest at this sort of 40%, 45% threshold. So you kind of want to show that as an IRR, is that your company is worth that. Otherwise, they're going to think it's too risky for the amount of reward. So, and so the IRR calculation is annually compounded return on the investment that the investors are making. So in this case, in year 0, they invest 1.25, and by the end, they get 14 million from it after 5 years. So that's a lot of money, and then we're like, cool, let's go for that.
Do you really get it back? Or is it
I'm going to talk about this in 1 second, because an exit value, this is, does anyone know what this is?
how much when you sell the company?
Right, exactly. So it's the amount you get when you sell the company, but also not when you sell the company. This is a little bit weird, but at the end of 5 years, you have to show what the company is worth at the end of 5 years. Because if you just make an IRR projection without an exit value in it, even if you're not planning on selling the company at all, it's going to be as if your company exists for 5 years and then vanishes off the face of the earth. And the IRR is going to look really crappy. Because it's going to be like, well, I invest this money in the first year, and then the company disappears after 5 years. So the exit value is saying, all right, if the company continues on forever, how much is it worth? Let's pretend like we're selling it after 5 years. Even if you're not selling it, you have to do that because otherwise the IRR looks really awful, as well it should, because it's a miscalculation of it. So this is the exit value, and you put it at the end of this 5-year projection. By the way, 5 years is pretty standard for a projection. It's what they like, I don't know, someone decided somewhere. 5 years. And then your SEA. Otherwise, you're estimating that the company is gone after 5 years. So you need an exit value. And so, yes, and often the way that they do this exit value is they take some kind of multiple of a metric. So like revenue, in a lot of cases, it'll be like 2 times your revenue in the following year. That's the exit value. Or like an operating margin, say 5 times your operating margin. Usually they don't do net profit because they like to come in and switch around the financing structure. So it's usually one of these sort of, we can go back to the income statement, but it's a bit further up than net profit because whatever debt you have, they're probably going to pay it off and they're going to put in their own things to finance it. So they just want to know, like I mentioned, that they'll be getting like the EBIT multiple. That's a common one too. 6 times EBIT multiple. They're like, okay, it's like that's how much it's worth, and that's what you use for the exit value. And so, that's important because, well, like I just said, otherwise it looks really awful because it's like your company ceases to exist after 5 years. So you need an exit multiple in there. And that's what this is. Okay. So right here, there's a big chunk. You see it's like this tiny little dividend, 1 million, 2 million, 41 million. That's the exit value. So you can imagine the IRR is not going to look very good without that 41 million in there. So it's really important. And I know we've covered a lot of things, and some of them are probably pretty confusing in some ways. So is there any general questions about any of this? Yes?
Handouts. I need handouts.
Sorry?
I need to read a little bit deeper inside materials so I can understand a bit more about your business. And can we have it by email?
Yeah, definitely. And that be...
Please take part here by Peter.
Sorry?
Yeah, that's all.
Yes, at the end, you can go to my website up there, and I've got the presentation all up there for you. So, and I give you a card as well. So the top one has the forms up there. So, yeah. All right. Yeah.
The multiples you mentioned, that we have to put that on there. So how do you find multiples of, how do you come up with a multiple of a similar company?
Yeah, you look at the ones that are sort of industry accepted, like the
No, but if you just Google multiple of,
you know,
you know,
yeah, so you can find them through that, or you're talking to, you know, I mean, actually, I recommend, because this market research is a little bit, you know, touch and go, but a lot of it you can do by calling one of the potential competitors and pretending to be a client, a new client, and this and that. And so, for example, with the investment multiples, you can call VCs and be like, you know, this, like this type of company, what we're talking about in terms of multiples, they'll know. I mean, you know, it'll be quite first and foremost in their calculations. So yeah, and then it's, you know, they might as well just have like a list. It's like, okay, well, it's like internet advertising related things, so we do, you know, 4 times EBITs, and that's like the way we value it. And it's always, you know, something like this. They have standard, you know, things that are passed down from their bosses, and they're told check it off and do this. Yep. All right. Anything else? See, that. I think that's pretty much it. Yep. Okay. So that's it. Yeah. So okay. So you know, somebody said like go to financialforums.com. You can find this presentation and all these things. And, yeah. And so when you make $1 million, remember me because I'm a financial advisor. And yeah, and you can always email me.
I've got a question. Sorry, David. Any tips on how to find these ideal investors? Which we just go to companies that are doing basically what we think our product might fit in, or is there a particular forum you guys might recommend?
I would say that's a tough one because they're very, you know, it depends. Once you reach a certain high net worth level, they're not putting themselves out there necessarily. They're already receiving all these solicitations. I would say just really, you know, if you go home and write down a list of everyone in the industry that you really think you'd be like, oh, they would be a great partner to have, you know, and that they're really familiar with what you're doing already, or at least they might be interested in it, and then sort of go from there. And don't be afraid to contact them, because, you know, you contact them by email, they either respond or not. If they're going to reject it, they're not going to write an email back, you're so stupid, LOL, you know, it's like they're not going to be like jerks about it, you know, they're just not going to respond to it. Or, you know, and you can even call them on the phone and, you know, they'll have a secretary say, hi, can I speak to, you know, so-and-so.
I just wondered if there was any special secrets.
Not really. I mean, you know, it's yeah, it's good if you can get to know them, which is again sort of what I was saying, ask for advice instead of money, because you can just start a dialogue with them, then your chances are going way up from sort of unsolicited submissions. So.
When Stelios was investing, sorry, I don't know his full name, but he was investing in different companies as well. So was he going after them, or were they approaching him? The
They were approaching.
So those who were actually searching for the investments.
Yeah.
Was he searching for?
I mean, sometimes it was one thing or another. So you know, maybe in some cases it was just someone he had known already, who was, you know, really nice if you can manage it. But a lot of times it was just submissions we would receive, and then they get considered and go through the steps of looking at them. So, yeah. All right.
I have a question. I want to ask, in your idea, if it is better for a company, for a startup company, to use financial software for maybe hire an accountant and just use a spreadsheet. Not just for a company, for the accountant, because I'm an accountant for a startup.
Yeah.
And I have the knowledge, but I don't know if it's better to use an accounting software or just use a spreadsheet.
It is. I mean, it's more detailed, but to find a nice balance between making it as detailed as possible and not spending 3 years, you know, working on this business plan. I would say for the early stages, and not even to have a full business, do more of an executive summary, because this is something I should mention. A lot of times for these investors, you have like a teaser, which is like a 2-page piece of paper, so back and front, that has like these little balance sheet, income statement or whatever, returns on it, and then some information about, you know, the marketing plan, but it's like 2 pages. and that's to get them interested in it. So, you know, and then in that case, you wouldn't need the accounting figures. It's just something that's you know, promoting the business, and the investor has time to read. Because otherwise, if your business plan is 80 pages long, and you're like, here, read this, you know, he's going to be like, I don't have time for that. You know? So, yeah, so as you go, make it piecemeal, like really build up to having these more established accounting, you know, records, all these kinds of things. Don't do it right at the beginning, and but yeah, I mean, I would hire an accountant to do, you know, the stuff once it gets the ball rolling, you know, once things are really looking like it's certain you're going to get an investor. Because one big mistake is to throw too much effort or too much time into, you know, a detail like that when you don't have any interest from an investor yet. Because then, you know, you spend months and months and months working on it, and then the investor doesn't come, and then, really, you know, it's like you wasted a lot of time, unfortunately. So, yeah, so really do it piecemeal, like bit by bit. I would say an Excel spreadsheet is more than enough for like the first stage.
Yeah, I might agree, because in a company that is a startup doesn't have a complicated transaction.
Yeah, exactly.
At the first, just has payments, not revenue, just payments.
Mhm.
It's not that much complicated.
Yeah, that's true. Yeah, yeah. So yeah, some line maybe no more than 25 lines of thing, you know. Yeah, it really doesn't have to be super detailed. Just you know, but it all feeding into having the market research feed into the numbers. So if they say, where did this number come from? That's, you know, you've done the research on that. So yeah. Yep. Okay. Any other questions?
How long does the investment process take?